When talking about cyber and privacy insurance, most think of computers and the data stored on them. But in 2009, there was a data breach in the US that started far from electronics, instead from the labels on pill bottles, thrown away carelessly in open dumpsters by one of the largest pharmaceutical chains in the US. In an age where technology follows us everywhere, from our cell phones to our laptops, cyber protection has never before been such a hot topic.
I think cyber insurance has been around now for 10, 11 years as a product, and it's been in its early infant stages, and we're just starting to see it at its most exciting point. I think people estimate the size of the market now to be between about $405 million in terms of total size. It's in North America. But the estimates in the market at the moment are saying that's going to grow by 3 or 4 times over the next couple of years. So now's an incredibly exciting time to be involved in the market.
Graeme Newman of CFC Underwriting says electronic privacy breaches are not always coming from an electronic source, and that non-electronic breaches can do just as much damage. These and other important coverage points of cyber and privacy insurance are what agents should be looking at carefully from the beginning.
I think the most important coverage point when you're looking at any privacy policy is exactly whether it's going to respond on the first party breach notification, because that's the very first aspect of cover that's triggered. So when you have a breach now under various state laws, you're actually obliged to notify all your end customers. So many of these small add-ons that we've been seeing appearing recently in standard BOP package policies don't actually give you any cover for the notification piece itself. And that can become incredibly expensive when you have to write a letter to 100,000 customers, which needs to be drafted by a lawyer beforehand. Another aspect of cover that I think you need to look at very carefully is whether you're covered for contractual liability or not. Most of the damages that we're seeing when it comes to actual claims are coming through contractual liability. So it can be a breach of a merchant agreement in the case of a credit card breach. If it's a piece of commercial data, it can come through a non-disclosure agreement, which again is breach of contract. The HIPAA regulations, and we've recently seen the High-Tech Act, which is known as son of HIPAA, that's put in place requirements for business associate agreements between healthcare organisations and their providers. And again, breaches of data and confidentiality breaches are triggering warranties under those contracts. So contractual liability is a tough area. It's one that's excluded in many forms, but it's one that's so critical to overall coverage.
Newman says that one of the hardest things in dealing with cyber and privacy liability is that it covers such a broad spectrum. So the key is understanding what you are buying and what your client needs.
They can go from everything from a very, very simple liability policy that's designed to cover you for liability associated with transmitting a virus, or liability associated with your systems being used to hack somebody else's, right through to something much, much more complex as a product that will cover liabilities, like the ones I talked about, but extend to media risks like defamation, intellectual property rights infringement, through to first-party risks like losses of data or system business interruption. So the problem is for brokers, it's just working out the differences between these policies because they're so far apart. It's not like a standard GL policy or a standard E&O policy. There's lots of differences to look out for. So it's trying to work out what the core areas of cover are and making sure that you've got all the bases covered.
Objections from customers often come because companies think their IT team has them covered when it comes to their cybersecurity. Newman explains that this can be a false sense of security.
They'll probably bring in their information security officer or their head of security. And the reaction you'll often get from them is, hey, we're 100% secure. We've got passwords, we've got encryption, we've got firewalls, we've got antivirus software, how could anything go wrong? Well, insurance is just simply another layer of protection. If you think about property insurance, and you think about your typical property client, they'll probably have a survey. You'll see them having CCTV cameras, there'll be security guards, there'll be locks on the windows and the doors, yet they still insure their property. And this is no different. We're just talking about some risk management, and that has to be in place before you can put the insurance on top. The problem is, at the end of the day, people use data, people use systems, and people tend to be a little bit careless. So we're always the weakest link in any security chain.
So it's one thing to convince your client that they want cyber insurance, but it's just as important to make sure you are also getting them what they need. Cyber and privacy coverage may still be a niche market, but it's no doubt a growing sector in the insurance industry.
We're a London market. We write on behalf of 16 different syndicates at Lloyd's. Our product is a surplus lines, non-admitted product. So retail brokers will have to approach us through a registered surplus lines agent. We work with a variety of wholesalers, from smaller independent wholesalers to the very large wholesalers. So hopefully everybody's got access to us in some shape or form.